Hello and welcome to a mini trading tutorial from OptionsAtoZ.com, the website dedicated to teaching investors the art and science of options trading. In this video, we're going to answer the commonly asked question among option traders: do trading systems provide an edge? A trading system can be thought of as a series of predetermined steps or trading rules designed to beat the odds. Can such a system be designed? Many traders firmly believe so and end up putting good money into a surefire failing system. In this video, we'll show you why. Let's take a look at a commonly used system by gamblers and many option traders called a martingale. A martingale is typically used for even money bets. An even money bet is where the amount you can win is exactly the amount you can lose. For example, if you have the opportunity to flip a coin and win $1 if it lands heads, but lose $1 if it lands tails, then that is an even money bet. How would a martingale system work for this coin tossing game? The martingale system suggests to begin by betting some amount, say $1, for the opportunity to win $1. If you lose that bet, you will double your bet on the next flip and wager $2 for the opportunity to make $2. If you lose that bet, you would again double your stake and wager $4 on the next flip for the opportunity to win $4. But if you're unlucky enough to lose that bet, you would again double your bet to $8 for the opportunity to make $8, and so on. The idea is that whenever you lose, you always double the amount of the previous bet until you win. The theory is that eventually the coin must land heads. It would be virtually impossible for the coin to dodge heads for hundreds of flips. Once the coin lands heads, you would double the amount of your initial bet. To understand why, take a look at the pattern. If you win on the first flip, you obviously have doubled your money by winning $1. However, if you lose that flip, you must bet $2. And if you win here, you are up $2, but you lost $1 from before, which leaves you up $1. If you lose the second toss, though, you must bet $4 on the next toss, and will win $4 there if you're lucky enough to win, but will have spent a total of $3 for, again, a net gain of $1. No matter which flip you win, you will always end up doubling the amount of your initial bet. If you have a lot of money to sustain the ever so small chance of a long series of losses, the martingale seems like a guaranteed way to double your money based on the assumption that the coin must eventually land on heads. The logic seems flawless and the temptation strong, but what are the results if the odds are against you? Let's use the casino game of roulette and see if the martingale can overcome the house edge. The game of roulette uses a table like this with 38 numbers. 18 are red, 18 black, and the two numbers here at the top, the 0 and 00, are in green. Many types of bets can be placed at roulette, but one of the simplest is to bet on red or black. For this bet, you simply put your money on black down here or on red, and if a black or red number happens to show, the casino pays dollar for dollar, exactly like our previous coin tossing example. So this is a perfect way to test the martingale. If you bet on red, for example, and the wheel is spun, a red, black, or green number must show. Here's the catch. You have 18 out of 38 ways to win and 20 out of 38 ways to lose, since the green numbers never count as red or black. It is the presence of the two green numbers that provide the casino's edge for the red or black bet. Therefore, if you were to bet on red or black for thousands of tries, you would expect to win $1 18 out of 38 tries, and lose $1 20 out of every 38 tries. And if you divide these numbers out in parentheses, multiply by positive and negative $1, and sum them up, you would get minus 0.0526. And this simply means that for every dollar you bet, you are effectively losing a little over 5 cents per spin. So the house edge for the red or black bet is 5.26%. By betting on red or black, you will lose 5.26% of all money bet in the long run. Can the martingale strategy overcome these adverse odds and ensure an ultimate win and double the gambler's money, since red or black must eventually show? Well, let's put the martingale to the test and see if a gambler can beat the casino by using such a strategy. Let's assume a gambler walks into a casino with $2,047, which is exactly enough money to lose 10 consecutive spins of the roulette wheel, a highly unlikely event. But just in case a string of bad luck occurs, he's prepared to sustain 10 consecutive losses. What can we expect to happen in the long run? Well, this table shows, and it's fairly easy to read, the first row right here shows that the gambler sustains 0 losses. That is, he wins in the first round. He will have bet $1. His total bet, of course, will be $1, and we're assuming he wins, so his return will be $1. But one of the most important points when you're talking about trading systems is to understand that you must account for all probabilities. What is the probability that the gambler wins in the first round? This is easy to show, as we've done before. We just have to find that there are 18 ways to win out of 38 total outcomes. If we divide those out, we find that we get 0.474. So a little over 47% of the time will the gambler win on the first spin. There are a couple other pieces of information we'll need. One is called the expected bet, and one is the expected return. The expected bet, we're just going to take the probability times the amount bet, and the expected return takes the probability times the amount returned, which will always be $1, assuming that the gambler wins. Well, what happens if the gambler loses on the first spin? Well, just drop down to the second row. We're assuming he has now incurred 1 loss, and according to the Martingale, he must bet $2. If he wins this round, he earns $2. He lost $1 from the previous round, which of course gives him a total return of $1. If he loses this round, his total bet at this point would be $3. What's the probability that the gambler loses in the first round but wins in the second? Hopefully you're starting to see the pattern. We're just going to take the probability of a loss followed by the probability for a win. Probability for a loss is 20 out of 38 ways. Multiply it by the probability for a win, which is 18 out of 38 ways. And if we divide these numbers out and multiply them, we'll get 0.249. So a little under 25% of the time will the gambler lose on the first spin and then win on the second. The rest of the table is filled out in a similar manner and is fairly straightforward until you get down to the bottom 2 rows here where we have seems to have accounted for this 10th spin twice. And the reason for that is if the gambler is unlucky enough to sustain 9 consecutive losses and he has to go to this 10th spin, one of 2 things can happen. He can either win that round or he can lose. On the 9th round, if he has bet $512, the Martingale says he must double it to $1,024. And if he wins this round, as always, he will pick up $1. He will double his initial stake. But if he loses this round, that's why we have a second 10 here, he will lose all $2,047. You can see that we have accounted for all probabilities because if we sum up this column, it comes up to 1.0, so all possibilities have been accounted for. What can the gambler expect in the long run? Well, let's take the average of the expected return, minus 0.063, and the average expected bet, just take the average of these 2 columns right here, comes up to 1.2. And what we might call in finance as the yield, which would just be the expected return divided by the expected bet. In other words, what should you expect for your efforts? Well, if we take minus 0.063 divided by 1.2, guess what we get? Minus 0.0526, exactly the casino's edge. When it comes to trading systems, it is not possible to overcome a negative edge once probabilities are considered. Why then is the Martingale so intuitively appealing? Well, trading systems do allow you to alter the distributions of rewards. So the Martingale does give a better chance for success, but only if you are willing to accept a smaller chance for devastating losses. The probabilities must always balance. The Martingale or any other system cannot protect you from an adverse edge in the long run. This is one of the many reasons I advocate using the Thinkorswim platform, as it clearly shows the probabilities for all outcomes. Traders can create what-if scenarios and build strategies that suit their needs based on risk and reward, rather than trying to beat the markets with a trading system. Thinkorswim is the only platform on the market that gives traders the flexibility to make such clear-cut decisions.